The half-year season is here with us, and this is CFO Chat. As always, any corporate action, you have the detail here, and we're privileged to have Lawrence Kimathi, KCB CFO. Welcome on set.
Thank you very much.
Always glad to have you. Lawrence, I got the numbers, looked at them, I thought face value, very impressive. But I have questions around the quality of the earnings. If you look at non-funded income, for instance, single-digit growth, and remember we are coming from really flat earnings in Q1. How would you assess the quality of earnings?
I would say overall not bad, but you're right in terms of singling out our non-funded income growth, and even our non-funded as a percentage of total income is not where we would want it to be. I'll try and unpack why we are where we are. So a couple of things. One, if you recall, there was a waiver that we've been mandated to give support to our customers, especially on the bank-to-customer transactions on mobile. So that, whilst last year we had one full quarter of charging that, in 2021, both quarter one and quarter two we have not charged. So that has an impact on it in terms of just looking at the like-for-like comparison. The second one is we took a decision also last year to just reduce the risk buckets we operate in on the mobile lending product, which generates direct fees to us, and by so doing, reducing those risk buckets, it meant that what we disburse has also considerably gone down, and that has also played a big role in that contribution. I would say, looking into the second half of the year, we have products in the pipeline that are going to come to greatly offset what we cannot charge at the moment, and we expect that we should be able to go to recover and deliver double-digit growth on that line. If you recall, we have a target that we've set on the contribution of our fee income as a percentage of total income in the next 3 years to be at 40%. We have delivered 28 so far, not where we would want to be by a long shot. We are working extremely hard to make sure that we are delivering, generating fee income, be it out of our digital channels, propositions, be it out of just the facilities that we offer our customers, and the add-on that comes out of a portfolio. So looking at customers more from a portfolio and less from a one product point of view. So when I look at our market share on lending, on loans, is usually almost double that of fees, which means that we are living our breakfast on the table. We are happy to lend, and you then take your business to somebody else. So just focusing on that. We also believe, from an FX point of view, foreign exchange trading, much as the momentum is in the right direction in terms of growth, when I compare that with our peers, we are not punching at the right level of a bank that is delivering a balance sheet of 1 trillion. So there's a lot of opportunities. We are using our advanced analytics team now to analyze this for us, point us in the right direction, have these conversations with our business teams, and get them to go and deliver.
All right. I see. And still on the quality of earnings, if you strip out the impact that the reduction in loan loss provision had, you realize it really pulled significant weight in the performance this time. Someone looking at the numbers would say, are you now considering that the risk outside there has been significantly mitigated?
I would say that it's not that the risk has been significantly mitigated, but we have already accounted for that risk significantly. So last year was the year that we, using our forward-looking information in the IFRS models, we are able to price in and take cover that risk that we had seen. Specifically, individually on accounts that we we could directly see the impact, and more general from an overlay that at the end of the year we decided to plug in just to cover a general risk that we expected the pandemic to have on our book. So our reduction on and also remember Q2 last year was the first quarter of COVID. Yeah, so a lot was not known. We were quite aggressive and prudent in saying let's just be safe and take the appropriate level of provisioning, and you will see as the year goes a bit of that unwinding.
Is KCB still clustering mobile lending in that risk bucket, which is really adversely perceived, if I could say, because you remember you had really slowed down in terms of lending on that channel?
Yeah, well, we have expanded our risk buckets. We have brought in new customers. We have also given new what we call balances in terms of limits for customers to be able to borrow from us. We are seeing a big interplay in the mobile lending world. Fuliza is doing fairly well. We participate in Fuliza as one of the banks. So some customers moved to the Fuliza proposition, and that interplay is there. We now have our Vuma loan, which is what we used to call Mobi loan before. It was specifically to bank customers with a conventional bank account at KCB. We have migrated that to our Vuma platform. So the speeds of processing are much faster, ability to monitor and apply algorithms and advanced analytics much better, and we believe that product also will be growing quite significantly.
Okay. Lawrence, looking at your loan book, I have concerns, and my concern is that when I look at the growth pockets in your loan book, it is largely in transport and real estate. And these are sectors which in the last 1 year at least we have seen are extremely vulnerable to the shocks of COVID-19. Don't you think you're extremely exposed on that side?
Well, not really. I would say you have looked at two sectors. Our loan book is 607 billion when you look at it from a net point of view. We play fairly big. I think we are the largest in manufacturing. We are very good. But coming to these two sectors that you specifically picked, let me start with real estate. Real estate, we are seeing some pressure coming, especially on the commercial side. So when I look at my NPL in the trend in the last 3 quarters, there's a gradual upward movement, which is the wrong direction for non-performing loans coming out, and it's specifically out of the commercial side. So people who have developed offices and the retail front, malls and shopping centers. So we see some strain coming out of that side. So we are monitoring that. The other side, the homes and personal mortgages, those seem to be performing fairly well. On the transport, now transport, there's no more social distancing. so I see that as an upside. I mean, from where I sit, others might not see it the same way for the dangers it brings. But I would say they've already gone through their worst part of restrictions in my mind, and looking forward, I don't think it's the picture will be as gloomy. But this virus has taught us that it changes very quickly and can easily go into another more serious lockdown.
Considering how strong your bottom line was in the half year ended June, an interim dividend surely, Lawrence. I thought the bank would have been gracious enough to extend this to shareholders.
It is a question that we actually did debate, and I'll tell you, we took the decision for two main reasons. One, we are just at the tail end of making the acquisitions that the shareholders approved for us to do in Rwanda and Tanzania. That's a cash deal. We'll need to be paying off that in cash. And the second part was linked to my last statement in terms of the virus has taught us not to take it for granted. So much as we are seeing rebound, we are seeing vibrancy in the economy, we can also very easily go back down to lockdowns and that will obviously have a negative impact on the bank. So to take a longer term view, we took the decision that let us review performance in Q3 and see whether this momentum is really sustainable and take a decision on dividends from there.
Speaking about your regional exploits, the move into Rwanda, one of the concerns I have about Rwanda is that it's a market which has a very significant dominant player in the name of Bank of Kigali. What's your strategy there? Are you going in for what niched segment?
So we believe, when you look at the performance of the bank we're acquiring, sits between number 2 and number 3, depending on what aspect, what measure you want to look at it from. They already have value. They make profits similar, close to what KCB Rwanda makes. They've got a large network of branches. We also have a number of branches in there. So the synergies that you create by putting these two banks together, the value will just drop to the bottom line. That's one. Two, it's very complementary because they are more retail, we are more corporate. So just being able to use our corporate customer, bank the SMEs and the value chain down to the retail, just brings in synergetic value creation to grow your top line. So we see a lot of opportunities in this acquisition, and yes, Bank of Kigali is large, it's dominant, but in an economy that is growing like Rwanda, you can't only have one bank.
Interesting, and we wish you all the best as you venture into that. KCB has finally crossed their trillion shillings in asset base, and my interest is in the targeted asset mix, especially considering how much KCB has been speaking about green assets going forward.
So thank you. We have been looking forward to hitting the 1 trillion mark, and it's good that we've gone above that. I think it will have a lot of positive consequences in the market. We will be able to partner with government on big projects. It gives us an assurance and safety also to the retail customers that you invest with us. The balance sheet is a firm foundation for you to be comfortable enough that you will get your money back. But coming to your question about the green assets, yes, we are very serious about growing the green line of assets, and we believe at the moment I think we are sitting at about 75 billion of our assets classified as green, and we would want to grow that to a quarter of the total loans in the future.
Great. Still on the subject of KCB and asset quality at the consolidated level, on the aggregate number up by some margin, but when I look at the ratio NPL, not too bad. Would you say you're comfortable with how it's looking, or what are the efforts going forward?
With the double-digit NPL ratio, I don't think we can be very comfortable. Before we acquired NBK, we were always at single digit. When we brought in NBK, obviously, when you consolidate, that figure went upwards. We are working to bring it down. Winning the recovery initiative that we have at National Bank of Kenya is going to be very pivotal in bringing that number down to single digit. This was one of the opportunities we saw when we took the decision to acquire NBK, and 2020 was not the right environment for recoveries, obviously. With what we are seeing happening in the operating environment this year, we are seeing momentum coming through on recoveries, and our long-term goal 2-3 years is to get down to single digit.
Okay. Speaking about NBK, I really thought NBK was a sweet spot in these numbers and in this sense. The loan book is now growing, 20% from what I computed. NPLs are down. Would you say NBK is out of the woods? And while at that, are there plans to further capitalize the entity?
You're right, NBK has been a very good story. Hitting 1 billion in half year. That was a milestone we had set for them, just like our 1 trillion balance sheet, and they have delivered. We are seeing the momentum coming through. We are cautiously optimistic the operating environment will play a big role in ensuring that that momentum is sustained into the end of the year. We did capitalize them at the beginning of the year. We gave them a tier 2 facility, covered their total income, total capital adequacy ratio that is compliant. At core capital level, there's still a gap. The momentum that they are delivering from their performance is bridging that gap, and we shall review the situation in Q3.
Okay, let's wrap up this conversation, Lawrence. When you look forward in terms of your portfolio at risk, what's your assessment in terms of how KCB sits?
I would say that our worry is more in the hospitality, hotel and airline part of sectors from a risk point of view. One, we are just coming out of a pandemic. You can see even hosting this event today, we had a quarter of the number of people we would normally have. So you can imagine, what the hotel industry is going through. Secondly, we are getting into an election year. So usually that also has an impact from the number of visitors who come to us, and that impacts the airlines as well. So that part is a sector that we are watching very carefully and worried about. Road construction is another one where we've seen government taking a bit long to pay. We've got our own policies. If the customer hasn't serviced their facility for a period of time, then we've got to, we look at as an early alert and a portfolio that we need to monitor. So that also is an area that a sector that we are concerned about. So I would say those two is what, on an overall point of view, those are the portfolios that concern us.
And then I was surprised now, just tying it onto that you see no need to assess your cost of risk guidance that you've given to the market. Do you think that's a wise position to take?
Yes, it is. It is, because I know the amount of work that we are putting down to make sure that we get to that 1.8% cost of risk, which is almost double what we've used to deliver in a normal year in the past. So I believe you've got to put a stretching target and work towards it, than adjusting your position and getting comfortable because you've told the markets that you will deliver a softer target.